lam, lam, ding, dong, ding, dong.
Rough stuff. Ugh. Hey everyone, this is Rachel with your Tech Talk Tuesday from MarketEdge.com. With me this week is David Blake, our resident expert, here to tell us what's going on in the news. David, how are you?
I'm doing well, Rachel. Thank you. We had a wild week on Wall Street. The headline last week. We saw the major averages actually finish mixed after we had the banking jitters fueled more recession fears. And part of that reason was because we had a lot of investors move over to the big cap technology stocks as a safety trade, thinking, well, they got good balance sheets. They're not going anywhere. So if we do go into recession, they should probably still be able to do some business. But anyway, to start the week off last week, we did have some carryover from the SVB Financial collapse from the previous Friday. And we saw the major averages pretty much take a nosedive on Monday. There's a run on deposits as expected over some of the other Western regional banks. That included First Republic and PacWest and like Western Alliance and some of the couple other ones. And basically we saw the first couple hours of trading, we saw the market sell off hard. The Dow was down a couple hundred, 300 or 400 points. And then we kind of got a little bit of a rebound the last hour, a little bit of a bounce. People came in, and I just wanted to start, some rumors started to come by that there's some of the other money center banks and stuff were going to help bail out, and that brought the market up. So then on Tuesday, we got a CPI report in the morning which showed prices were cooling again. That pushed yields a little bit lower, and we got that little bit of a boost from the government saying they were going to guarantee deposits at several of those banks. So we had a little bit of a reef rally early. But then in the afternoon, we started to sell off again. Part of that was the fact that there were more rumors going around that Credit Suisse was having liquidity problems, and that sent stocks pretty much just dropping into the weekend. The NASDAQ had several days where it outperformed again because of the big cap technology shares, but the small caps, because they have a lot of the regional banks in the Russell 2000 and the S&P 500 has a lot of banking shares. They really couldn't do much last week. Now, as far as the big cap stocks went, we had big gains last week in Microsoft and Meta Platforms, Apple, Nvidia. They were all up almost double digits on the week. We saw movement going even into the semiconductors midweek. In fact, the Philadelphia Semiconductor Index surged about 4.05% last week. So it had a big day. That showed a little bit of positive divergence. And so we came in here yesterday, and again, we got we had a nice little rebound. I called it a little bit of a relief rally again yesterday. And that was due again to several of the banks coming in, guaranteeing the deposits. Janet Yellen has been talking about maybe the federal bank needs to make higher guarantee on some deposits. And then UBS also acquiring Credit Suisse. If you're a bond holder, not such a great deal, but if you're just a investor in UBS, it's not a bad little deal. The Dow outperformed, and that was because the previous week we had the big cap tech stocks, surged almost 8, 9, 10%, and we saw a little bit of profit taking in that yesterday. In fact, Microsoft and Intel were the only two Dow stocks that finished in the red yesterday. They were both down about 2%. Everything else was strong. As far as some of the other things that we follow in here, we saw crude oil prices down last week. They were down about 14%. Reason for that being that as the banks were starting to blow up, that kind of fed recession fears, which weighs on a lot of the commodities, that type of thing. We actually saw crude oil go down to finish at 66.28 a barrel on Friday. Yesterday, it dipped down to 64 and change. And then we saw it bounce up and finish actually a little bit higher yesterday afternoon. I think it closed around 67. And then we were up some today. Again, that's as recession fears start to, waylay a little bit to the side. Again, we're starting to see some of the commodities pick up a little bit. As far as the rates go, we saw the 2-year Treasury, which was just at or 5.08 just about a week to 10 days ago. It settled on last Friday at 3.83. That's a huge move in a short-term Treasury bill. I don't know if I've ever seen anything like that. We had the 10-year came down to about 3.4. That seems to be, anytime it's below 3.5, we usually get a little bit of a rally in the stocks. Although today we're having it pick up a little bit around the 3.5 range. But as far as what we saw, adding to the gains last week, it was basically technology, communication services, and then of course utilities were strong last week because that's another defensive play that we, investors want to move into. Strangely enough, today those are actually some of the weaker sectors. We're starting to see more industrials, seeing a lot more going back into energy after that big sell-off. People jumping up on the financials again today, the industrials, that type of thing. Again, everything that was so oversold last week, we're having people jump in there and buy those. So the big tumble going into the weekend left the Dow only down about 47 points. That's probably a little bit surprising, but the NASDAQ was actually up 4.4%. That was its best week of the year. Russell 2000 was off about 2.6%, and again, the secondary indexes, which included the transports, they were off a little bit, and in the semiconductors showed positive divergence, with the NASDAQ as people kind of are getting out of that heavy landing scenario that they're looking at. Now we're back today to the maybe it's going to be a soft landing or no landing stock, which I'm not so sure about that. I still think we're probably going to see things ratchet down later on. The technical condition of the market last week was mixed. Again, we saw the positive divergence, especially from the NASDAQ and S&P 500, while most of the other indexes drifted lower. We had put price targets on the Dow and S&P and NASDAQ the week before. The Dow hit our initial target of 31,750. That represented a 50% retracement of the October-January rally. The Dow did continue lower and actually went down to 31,450, something like that. So that was where we bounced off of. The NASDAQ got close to our target. I think that was, the NASDAQ got close to the 1090 target. I think it got down to about 10,980, something like that. And then it's bounced as we had that rotation into the tech, and it's moved higher from there. The technical indicators are they're kind of neutral, but momentum is measured by the 14-day RSI. It improved. It's been moving higher. The secondary indexes, like I said, they kind of gave mixed signals. The Russell 2000 Transports Index were actually two of the weaker performers last week, and then we had the SOX, outperform. So that was again mixed signals there. The Philadelphia Semiconductor for the week was up 5.5%, and again, it's actually close to putting in a new high for the year, I believe, year to date. So that's something. So again, the mixed signals are kind of clouding what's going to go on here. Underlying breadth was negative despite the mixed finish, and we had as far on, I think it was on Wednesday or Thursday, new 52-week lows on the NASDAQ actually were reached numbers we hadn't seen since mid-October. I think it was something like 650 stocks hit a new 52-week low, which we don't like to see. And then, as expected, we saw a big drop in the number of bulls on the retail and professionals. So going forward, right in here, we have the FOMC is meeting right now as we speak, and tomorrow at 2:00 we should see. We'll get the announcement on rates. At the time yesterday, it was about a 76-77% probability that they would raise rates a quarter of a point. The reason I think they're going to do that, and I wrote about this a couple of times, is they've got now it's up to 82% for a quarter point. Part of that is they've got to save face a little bit. They can't come out tomorrow and act like they were completely shocked by what happened to the banking system. They need to show a little bit of confidence to investors that they were aware that this could happen, and now they're going to take a little bit of slower pace and evaluate what goes on. The tricky part, I think, for the Fed tomorrow is going to be that he can't come out and say, hey, we're going to stop and see what happens here for a while, and we don't know how long that's going to take, and we see the market go up 1,000 points. The Federal Reserve doesn't want that. They don't want us to create some kind of a bubble. As you know, in the past, every time they started talking about slowing down the rate hikes, you got a nice pop in the market. It's going to be hard for him to sound off that they're slowing and probably pausing to see what kind of damage we have left to go on this from the rate hikes. I mean, obviously, you go from a 0 up to 5% in a year. You're going to have some problems with the balance sheets. As we spoke a couple of times before, all the banks were loaded with all these Treasury bills that they were paying at 1% and all that, and now that they're now they've gone up to where they can get a 5%. If they have to cash those in, they get 30-40 cents on the dollar, and that's what's causing some of these problems. So I think it'll be interesting to watch. As far as today's movement went, we went up to the resistance levels for some of these indexes. We saw the S&P 500 actually gapped back up above its 200-day moving average, which we've been kind of watching. 200 and the 100-day. It's just below the 50-day moving average. The Dow Jones gapped up also. It needed to get to 32,370, and that's where we pretty much gapped up right to that level, went up to about 32.5, and now it's kind of sitting on that 32,400 as we speak right now. I think it's probably going to hold that area, especially going into tomorrow. If we start to get the Fed comes out and says, by God, our mandate is to get inflation down, and we still need to go, or if we go a half a point, they'll go a half a point. You might as well have some tickets ready to sell some things, because the market's going to take a real dive. But we're kind of back with some of these indexes almost to where we were previously when they announced the bank collapse. We've almost done almost a round trip on some of these. I would think again tomorrow, depending how Fed Chair Powell dances around a slowdown with rates, we probably can get the market probably moving higher. I also hope we don't see a 1,000-point rally just because he's going to pause. I don't think that would be there still may be some fallout in some of this banking stuff that we see, and I think that if we do, we'd probably see some people starting to sell any kind of relief rally. But if things settle down here, I think that we can probably start to grind higher into April and into May. They're usually seasonality comes into effect here also, where the market historically. Those are two of the strongest months of the year for stocks and equities. So I think at this point the worst is behind us. That was the previous last Wednesday or Thursday, whatever it was. And like I said, I think now we could get a quarter point tomorrow, and then we just kind of grind forward from here. And investors will kind of keep an eye out to make sure there's not any more fallout from the banking crisis.
As you said, the banking collapse surprised Wall Street, and unfortunately, a lot of investors got burned in the sell-off. As a MarketEdge subscriber, how could I have used the site to maybe have prevented a big loss like that? Maybe you could suggest some trading tips that could help our subscribers sell a stock before they lose too big.
All right. Well, like you said, last week, investors were caught off guard by that SVB bank collapse. And then, of course, the subsequent sell-off to the other regional banks. And I give kudos to Janet Yellen and the money center banks. They got together pretty quickly and prevented more damage to the system. And so so many people were talking about, we're having a crisis of confidence in central banks and bank managers. But again, it wasn't good, obviously, and and I think there'll still be some repercussions going forward to that, but we'll have to see. Now, so we step back and see what we could have done, if you were a MarketEdge subscriber. First of all, I get emails occasionally and said, hey, that stock just jumped up 10 points, and you guys have a neutral on it, or you just have a stock is deteriorating, something like that. Or the stock, came out with earnings and it dropped 10 points. Why do you guys have a long on that? Or why is it a buy? Okay, first of all, technical analysis isn't going to catch that. Any programs that you see out there that say, oh, we caught that, we recommended this to sell this here right before it fell, we recommended to buy this right before it goes up. Now there are occasions where you're going to have positive and negative divergence that we talk about that generally hints at what's going on. You'll start to see something, the technical indicators improve or start to deteriorate before a stock makes a big move. However, something like that is what is called a fundamental change in the stock. It's not a technical change to the stock beforehand. In other words, it's a surprise. That surprised the market. They got the news. They sold it like crazy, or they got the news. It surprised to the upside, and everybody jumped in and bought it. And it was a fundamental occurrence that happened that made the stock fly up and fly down. We don't try to do that. We don't say we're going to try to do that. Again, we will pick up positive and negative divergences in our second opinion, and hopefully let you know that here's a stock I'm watching. It did go above. It just got upgraded to a neutral. Now it's an early entry buy, and you're watching it, and eventually that this is probably it's improving technically. I know the fundamentals are good. I'm going to go ahead and buy the stock. And by doing that enables you to have a good disciplined reason for buying the stock. And when we start to downgrade a stock as it's been going up for a while, it gives you a good disciplined reason. The same reason why you bought or sold every time, and because of that, you're going to more like a portfolio manager, and you're not surprised. You don't say, oh, I should have bought that, or I should have sold this when it started to break down. You don't have to fall in love with these companies. The reason you're in the stock market is to make money. And when I talk about the divergences, what I mean by that is, let's just say a company is getting ready to announce earnings. You're all excited about it. You think things have gone great. You're expecting, the last quarter was a great quarter, but every time you look at the stock and you're getting ready for the earnings, it goes up, hits some resistance, and starts to pull back. And actually, when they're getting here a day or two before earnings, the stock has pulled back maybe 6 or 7%, and you're thinking, well, boy, maybe I should buy it in here ahead of the earnings and jump in. Okay, that is something that technical analysis is good for, because that's showing you negative divergence, and it's probably telling you that maybe whether it's insiders or people in the know, that they're probably selling the stock anytime it ticks higher, because they probably know that there may be something in the earnings call that's going to maybe surprise the market, and that's why it's just not a straight line up. Other times, as they're going into earnings, you'll see the stocks going up it's on good volume, it's oversold, and you don't see any pullbacks. That's usually a sign that everyone knows it's going to be, that they're going to come out with good earnings. Now, it may still go down after that because it's built into the price already went up, but that would be positive divergence going into an earnings season. So when you do see the negative divergence coming in, you probably want to you can buy a put if you're waiting for an announcement, or maybe you sell a covered call if it's something you want to hold on to for a long time. But you also want to look at some of the maybe you put a sell stop, something like that. But you're looking for something that there's hints in the analysis that show you that the things may not quite be what you're expecting. Okay, now in the banking case, Rachel, let's look at FRC. That's its First Republic. As you can see, back on February 1st or 2nd, it was trading up close to 150 a share, and then once they raised the rates, we started to see the thing tick down gradually down. It actually got down to about 113. But when I talk about, we're going to give you three signals or three chances to get out of a stock. Okay, we downgraded it on February 28th to a neutral. Okay, that's one of my signals. I'm getting ready to get out of this stock, and that was at 123. So, okay, you were out. It had pulled back about $20, but if you're out there, I don't know what the sell stop was on that day, but I do know it closed at, I think, at 123.08 or something like that. And then approximately 2 weeks later, the bottom fell out of it, and it went all the way down into the $5 or something like that. Okay, if we're getting a little bounce today, we're up around 16, but okay, that was your first signal. Again, it would have broken the sell stop when it was a long. Would have probably been maybe, I don't know, but I'm gonna guess maybe around 118, 119, something like that. So that would have been your second signal that the stock had, to get out. And then again, if the relative strength had fallen below one, maybe say to 0.98, to 0.97, something like that, that would have been your third signal. Okay, so you get out of it. Takes you a day to get out. You get out around 123, 120. That's a heck of a lot better than getting out $6 a share. And now this is the kind of example where maybe you don't know why the technicals were getting so bad that you were coming out, but you don't care. What MarketEdge is telling you is that the stock is deteriorating to the point where it looks like it's going to go lower. How low? Maybe the bottom would have been $100. I don't know. But the fact that you had three sell signals up here around between say 115 and 123, where you got out, and then it drops to $10 or whatever, where you're forced to sell, and God forbid if you were on margin or something like that. Okay, that's $90. If you had 100 shares, that's $9,000 we just saved you in your portfolio. That keeps you subscribing to MarketEdge probably for the next 50 years.
If you have any questions for David or anyone at the MarketEdge team, feel free to send us an email at support@marketedge.com or shoot us a message in that chat box in the lower right-hand corner of our website. We'd love to hear from you.